Most retail traders believe the forex market is unfair. They believe banks manipulate price. They believe institutions hunt their stop losses. But here is the uncomfortable truth no one likes to hear. Banks are not winning because they are evil. Retail traders are losing because they are predictable. Forex is not designed to reward effort, motivation, or hope. It rewards logic, structure, patience, and risk control. Today's video is not about indicators. It's not about entries or signals. It's about how the market really works and why banks consistently take money from traders who don't understand the game they are playing. If you watch this video till the end, you will never see the price the same way again. Retail traders are taught one dangerous lie. If you can predict where price is going, you will make money. So everything they learn revolves around indicators, patterns, signals, buy and sell predictions. But institutions don't trade predictions, they trade order executions. Banks don't care if price goes up or down. They care about where large volumes of orders can be filled efficiently. This is the first major mindset shift. Price does not move to reward correct predictions. Price moves to facilitate large transactions. If you don't understand this, the market will always feel confusing and unfair. Banks are not clicking buy and sell buttons the way retail traders do. They operate as market makers, liquidity providers, risk managers, hedgers. Their job is to match buyers and sellers, execute massive orders without slippage, manage exposure across currencies and assets. When a bank wants to enter a trade with huge size, it cannot do so randomly. It needs liquidity, counterparties, orders on the other side. And this is where retail traders come in. Liquidity simply means available orders. Where do retail traders place orders? Above obvious highs, below obvious lows, at breakouts, at textbook support and resistance. Where do retail traders place stop losses? Tight, obvious, clustered together. Institutions see this clearly. So when price approaches a high or low, banks are not thinking, let's trick the traders. They are thinking there's liquidity here. Price moves towards liquidity because liquidity is fuel. This is why breakouts often fail, price spikes and reverses. You get stopped out before the real move. Not because the market hates you, but because you are standing where others are needed. This is why the thumbnail says, you are liquidity. Retail traders lose because they behave the same way. They enter late, chase confirmation, use the same indicators, place stops in the same places, and react emotionally. This makes retail traders highly predictable, and predictability is weakness in financial markets. Banks don't need to beat retail traders. Retail traders beat themselves by overtrading, oversizing, ignoring risk, trading boredom instead of structure. Institutions simply take advantage of behavior that repeats over and over again. Retail traders ask, is this bullish or bearish? Banks ask, what happens when price reaches this level? They are not emotionally attached to direction. They wait for liquidity sweeps, stop runs, false breakouts, panic reactions. Then they step in after the damage is done. This is why institutional entries often look late on charts, but are actually precise and calculated. Retail traders want to be early, institutions want to be right. Retail traders focus on how much can I make? Banks focus on how much can I lose? Institutions survive because they risk small, they cap exposure, They think in portfolios, not single trades. One loss does not matter to a bank. 10 losses do not destroy them. But for retail traders, one oversized trade, one emotional decision, one revenge session can wipe out weeks or months of progress. This is why banks win. They survive long enough for probability to work. Retail traders trade news direction. They buy good news, they sell bad news. Banks use news as a liquidity event. News increases volatility. It triggers stops, forces emotional decisions. Institutions often position before news and exit during the chaos. That is why price often moves opposite the news, spikes then reverses, confuses retail traders. News is not information, it is liquidity delivery. Retail traders obsess over individual trades. Institutions evaluate 20 trades, 50 trades, 100 trades. They understand something retail traders struggle with. You can do everything right and still lose a trade. That doesn't mean your logic is wrong. It means you are playing a probabilistic game. Once you stop emotionally attaching to outcomes, your decision making improves dramatically. To think like institutions, retail traders must stop asking, where will price go? And start asking, where is liquidity? Who is trapped? What happens if price reaches this level? You don't need institutional capital. You need institutional patience and discipline. Banks don't win because they are smarter. They win because they follow better logic. The market is not against you. It's simply rewarding structure and punishing emotion. Once you stop being predictable, once you stop chasing price, once you stop trading like the crowd, you stop being liquidity. And that is when everything changes.